Good evening, everybody. This is Jeff Scott. It's 12/21/2014, and this is my weekend review. I titled this one Santa Strikes Back, as Santa's gone to war and beat back the Hindenburg Omen, at least for now. My email address, please contact me for any questions or comments. Disclaimer, as always, is for education purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I am not affiliated with any software vendor or trading company. Therefore, I paid for my tools just like you have, and I'm not biased in my presentation, I hope. And trading involves risks. You and you alone are solely responsible for any investment decisions that you make. As always, I like to tell people to become their own guru, and you do that by getting educated, whether it's years in the pit, as someone like John Person has done, or it's learning from others. And so mine is pretty simple. I started my journey with How to Make Money in Stocks by William O'Neill. I discovered Ian Woodward and Ron Brown, where they took the canceling process even further, and using HGSI software allowed me to automate it and make it more efficient. I had Morales and Katcher take the canceling process and add to it Bible gap ups, pocket pivots. Looking forward to Gil's next book, which is about short selling, which will be out, I think, in March. Alexander Elder, a little bit about philosophy of trading, money management, force index, impulse indicators. John Person, who I've learned a lot from. He's another top-down guy looking at market, sector rotation, finding stocks. And he's got a couple of scans that I rely upon. My favorite is his buy signal 2, which is finding stocks and uptrends that pull back to support and have momentum. And that's basically my trade. That's what I'm looking for as I do my analysis. And then Van Tharp for candlestick, and a Coling for money for volume price analysis. And then Tom Dorsey, although I'm not a point and figure guy necessarily, philosophically I agree with what they do, which is a very strong top-down approach. I have a lot of different tools. I hide them intentionally, but if I was to go on a desert isle, this is what I'd want to bring: TradeStation and or Thinkorswim, because that's where I trade. Genesis, which is what I monitor real-time in the market. HGSI for most of my analysis. ETF, Bandit, and EdgeRater supplement that. Seasonal analysis when it makes sense, and then I use a number of websites. Talked about this last week. We've basically been living at the top of this thing now for months. Keep wondering when we're going to roll over, and every time I think we're going to roll over, every time we get something like a Hindenburg, we take another leg up. So I guess we're back over here and looking for some more rally time this week. And to remind everybody, upcoming summit, February 7th through 9th. If you've already registered and you call the hotel to set up a room, just use the code HGSIDoc and you'll get a 15% reduction on the cost. 3-day meeting, George Lee and myself. Again, contact me at hgsidoc@gmail.com for any questions. Week ahead, there's some news and reports. GDP, third estimate, that shouldn't be much of a surprise. Michigan sentiment, final for December, that's a big thing. Home sales, initial claims, continuing claims. Reality is it's a holiday shortened week. Should be low volume, as many of the pros will be off. And low volume, holiday shortened weeks, got to be careful because you can get whipsawed and you can get big movements. And I've seen a lot of people say what Christmas giveth, New Year's taketh away. And after we get into January, we get into some more volume, and a lot of the moves that you might see that are exaggerated because of the lack of volume perhaps are eliminated. Tax loss selling should be reducing at this point as well. Not a whole lot of earnings unless you have Walgreens or CalAmp. HGR you can see here. And again, let's take a look at the charts. Let's take a quick look at the futures since they are open. Obviously, it was a very strong week in the market, and right now the futures are positive. They've come down a little bit from where they were an hour ago, but still slightly positive. And we'll be watching them, I'm sure, as this night goes by. I like to quickly look at TradeStation and get a sense of what I'm hearing or seeing from my indicators from the Elder package. And specifically, I'm looking at things such as the Elder Impulse Indicator, the color of the price bar, as well as looking for MACD divergences. And let's very quickly, let's go through the majors. The NASDAQ, obviously a very strong week last week. It's in green, so it pulled down here, had a Morningstar candle, and took off. Green is okay to buy or hold. You shouldn't be shorting. You could see we do have some MACD divergences. We made a high here, higher high here than we were back here, and we did it at just very minimal MACD histograms, so some of the participation had diminished. We haven't made a higher here, but we haven't even broken the back of the MACD. So clearly there are some MACD divergences at play, which might suggest it could be a limit to the upside. But as you can see here, the red dots being the MACD divergence, we can go quite a ways with that divergence before the market corrects. The Dow, spinning top light candle here. This is a person buy signal. There was one on the NASDAQ as well. Green, green, and green, some MACD divergence, but certainly on a buy signal. Russell futures, MACD divergence coming into the Russell here. And again, we hit a higher high here, but not a higher high on the MACD. So when you see that, you get a little bit nervous that the market might be losing a little bit of participation on the bull side, perhaps a little bit of the momentum is coming out, and you run the risk of this rally faltering, but it's all green, and that's important to me. NASDAQ 100 should look like the NASDAQ, as it does, although it's only blue on the weekly, MACD divergence in play. S&P 500, green, green, blue, MACD divergences in play, and S&P 100, greens all around with some MACD divergence on the weekly. So I look at this, and what do I take home from this? I take home that I can be buying. If you're interested in these impulse indicators and MACD divergence, they're very inexpensive compared to other indicators, and just go to www.elder.com if you have interest in that. Now, the other thing that I use this for, I use it for a lot of things, is we'll talk about the Commitment of Traders report and how I interpret it. The Commitment of Traders report measures three different things. It measures futures buying by yellow, which is us, the lay public, or the small time investors, I should say, not the lay public, but the small investors, the small speculators. Blue, which are the hedge funds and banks, the large speculators. And then this red line are the professional hedgers. And by hedgers, I mean if you're raising cows and they need something, corn to eat, and I'm making this up because I don't know anything about cows, and you want to protect yourself in case corn goes up, so you might hedge the price of corn by buying some calls that would allow you to buy it at the lower price. So I pretty much ignore the professionals and look at the big and small speculators, as the blue are the professionals that I worry about. So a couple things I want to point out here. First thing I want to point out is, let's go back to 07, 08, 09. And in 07, 08, 09, as the market topped and it came down, you notice that in yellow, the small speculators, being us, were buying, and the large speculators, the hedge funds, were selling. Then we get to 2009, and actually late in 2008, and this should have been a clue perhaps that the market was bottoming or had bottomed. You can see that the big speculators went long, and us, well, us small speculators, we did as small speculators do. We went the wrong way, and we went short. And then as you watch, what happened is this whole market has run up. it took until April of 2010, a whole year after the market had bottomed, for the small speculators to turn positive. So here we are. Let's take a look at where this market has been the last couple of months. So now I'm looking at 2014, the S&P. I won't say it's had a straight shot up, but it's had a fairly straight shot up. And we've been long where the large speculators have been short. And what's happened over the last couple of weeks? We're still net long, although the amount that we're long has gone down quite a bit, from 62 million there, from down to 15 million. And now you can see that the large speculators, the hedge funds, have started to come back into this market and have gone long the S&Ps, or the E-minis as this case may be. So to me, that's pretty exciting, because if the big boys are coming long in this market, then maybe that tells me that this market has more legs to run. Just for those that haven't been here before, the way that I use TradeStation is I build a giant radar screen and I run a large number of indicators and stuff throughout the day, looking for, and unfortunately I've got so many here, they're not all showing up right now. I can fix that, make it look prettier. Let me just do this. And I'm looking for things such as pocket pivots, Bible gap ups, mobile breakouts, breakdowns from a squeeze, green candle lows, red candle highs. And then I use John's proprietary indicators, looking for stocks breaking out with bullish reversal signals. So I do a number of different things during the market, trying to identify things that are working so I can take advantage real time and intraday. Now, before I jump to HGSI, let's take a look at some of the other tools that I use to understand how the market did last week. I think we all know how it did. It was really painful for 2 days and then really nice the last 3. That is, if you were long. Really great if you converted to long on day number 3. But here's showing you how great it was. So what I do is I take a large number of groups that I monitor. Some of them I own, some I look to own, some I use as scans to find things to own. And I look at performance from end of day last Friday to this Friday. So get an idea of what was working during the week. And I use end of day pricing. So it represents what I may have found at the end of the day on Friday, with the caveat you can't really buy end of day, so you didn't necessarily have a chance of buying them at this price. So what do we see? You see mostly black. In fact, only a few groups were red. So that means it was mostly a bullish week. Up here we find at number 34, not 34th ranked, we find the S&P 500 was up 3.41. I think it was the leader. I think it beat small stocks. That's a huge number for the S&P, especially when it was down the first 2 days. So it really had about a 5% probably turnaround from the beginning of the week, or from the lows on Tuesday. Now, I look at how HGS 100 did in the IBD 50 to get a sense of whether my growth stock screens were working or not. And you could see they had a great week, up about 2.5, but they trailed. I look at my current holdings. They were up 4.5%, and it was a wild week. I looked at the stocks that made my buy watch a week ago. They were up about the same as the S&P. And just sort of proof that beta is back, you could see that a list of high beta stocks that I capture weekly using MetaStock, just looking for high beta stocks, they were up 8.2% on the week, which is just amazing. Now they've been getting hammered. Hindis, we talked about them a lot. No Hindi the last several days. The Hindis that I was seeing on EdgeRater have dropped off. And I think there's a quirk in how EdgeRater looks at the rising moving average. But what happened, if you look at it a little closer, you can see that our new lows peaked at 12.22, and then fortunately they came off over the this was on Tuesday, and they came off Wednesday, Thursday, Friday, and we have the return of new highs. Hence, we lost go top here. We lost the new highs and new lows, both greater than 2.2, and we lost the Hindenburg-Omen, which is a good thing. From a bucketology perspective, kind of interesting how we've had a quick shift to the upper part of the Bollinger Bands. Not a big shocker, but we're not at a number that says we have to snap back. Just to give you an idea, this is what it looks like at a bottom with over 20% below the lower band. And this is what it looks like when we get toppy, when we start to get 20% above the upper band. This is not the pattern that we see here. How do you break the back of a bear? Well, you break it with some big moves. And you could see, although Friday was not a very exciting day necessarily, on Wednesday and Thursday, we had big kahunas on my market view across all the major markets that we look at. S&P 500, the Dow, industrials, NASDAQ, small stocks, S&P 100, S&P 1500, NYSE, so on and so forth. And these were enough to flip us out of red into yellow and green on percent B location and get my percent B times the bandwidth into the green zone, which is bullish, or at least more bullish than when it's red. But to me, that's pretty much tells me that I can be buying. So market looks strong here. The caveats obviously being that this is low volume, lots of things can whipsaw, and it's, you know, Santa Claus time, which is usually good for the bulls. So let's open up HGSI and let's go into Major Markets Plus, courtesy of Ron Brown and Ian Woodward, which is updated frequently. Last update October 2nd, 2014. And let's go into top-down view, which is all price and volume, heavier on Friday, but a little bit of consideration for 2 to 3 weeks ago, and a little bit more for the last 5 days. You can see that leadership in this market on Friday was NYSE, small caps, mid caps, NASDAQ. Really, the things that I would look at to see whether the market was strong were up at the top. Gold, volatility, silver down at the bottom. If I look at 5-day performance, you could see the Russell was up 3.8, S&P was up 3.4. So the small stocks, as measured by the Russell, did pretty well. Good. They're up 3.2 by the S&P 600. 1-day return 5.9 for oil and gas. Big move there. And you could also see lagging for the week was volatility, gold, and semiconductors. So now I like to look at some of the major things here to get a sense of what's going on. So we're going to start with the S&P 500. And if you don't know my views and don't know what these things are, then I refer you to last week's video where I went into great detail. So I look at this view for a couple of reasons. You could see we had a eureka occur on Wednesday. And as we talked about last week, that's sort of the HGSI follow-through day or exuberant day signal. Now, it'd be nice to see another up 1% on high volume day to confirm it, and perhaps maybe we could consider what we saw on Thursday, but that really was a signal that the market has changed and that the bulls were going back in control. And you can see what happened here with a series of eurekas, a PSAR reversal. We got some kahunas here, and we had a mobile breakout and led to a big market increase. Now I'm going to go to a cleaner view for the rest of my indexes, because the eureka is only going to occur once. It's on the NYSE, and we know there's lots of kahunas because of the Edge Rater tool. So this is the S&P 500, and don't need to spend a lot of time because it's just rehashing. In a big uptrend, I looked at a couple of different trend lines there, trying to figure out, kind of got a wedge perhaps forming right now, a rising wedge, and looking to see if we can break out above this and take out, at least horizontally, take out these highs that are here. So S&P looks good. They're all going to look the same. I'm telling you that up front, at least on the indexes. Here's the Dow. Here's its prior highs. Probably might have a little bit of support here. I was trying to decide if this is a inverse head and shoulders, and is this potentially a potential neckline that we broke above. That would be exciting. I guess the neckline could also be up here. But bottom line is we've not retaken our highs here. Big move off the bottom on the Dow. I look at the NASDAQ, ditto, not as much of a believable inverse head and shoulders perhaps. Got to get above this line and reach new highs, or at least new multi-year highs. You can see the volume on Friday, but there was some index re-indexing or whatever they call it. Russell 2000, it's trying to get above this line, sort of range bound right now. Really didn't fall back nearly as much as the other indexes. If I go and look at the dollar, dollar's been on a great bull run, continues to do well. I think it's as much the strength of the U.S. market versus the rest of the world as anything else. Unfortunately, the dollar probably is leading to some of the issue in oil, and this big drop in U.S. oil or black gold has obviously affected a lot of portfolios. Perhaps the selling has abated there. Also, a strong dollar, not great for gold. Failed again at the 50, or for silver. Failed again at the 50. Lastly, the VIX. We talked about it was on its way up last week, and when the VIX would turn around and head down would be the time that I'd want to be going long. And we got that reversal on Wednesday. Traded up, downside reversal, and sold off or fell lower. I don't think you can say sold off on Thursday and Friday. So from a market perspective, this is a strong market. Obviously, oil trying to put in a bottom. Gold and silver continue to be quite weak and made weaker by the strong dollar. Just a food for thought. Commodities have been hammered. This is the commodity index. Now, just imagine what your gut would be feeling like if that's what the stock market looked like. There's clearly been deflation in commodities, whether you look at oil, you look at gold, you look at silver. And natural gas has been weak for a long time. Look at gasoline, gosh, $2.55, fully taxed down here. I hope that they're not leading the stock market and that the market's not going to follow. But deflation remains a concern, and certainly in the commodities patch, it's been a problem. I think the quantitative easing worldwide now perhaps is why the markets and our stock portfolios have held up. Next, I'd like to go down and take a look at industry groups. Number 7, 177. Let's look at what's really moving now, 2-day up. And this is no surprise. Just to give you an idea, let's see if I can get this up here. Look at some of the moves in energy this past week. Talisman up 83%, Swift up 53%, Basic up 53%, Sanchez up 50%, Natural Gas Bull up 50%, Triangle up 42%, Pioneer up 41%, Oasis up 39%, Comstock up 37%, Goodrich up 36%, Stone up 34%, and so on and so forth. So no shocker. So let's just take a look at a couple of these charts, because they're not necessarily pretty charts, and you're kind of going to be bottom fishing as you decide what you want to do. But they've had big moves off. Anadarko Pete. Whoops. Let's switch this to my chart view. And again, I refer you to last week's webinar where I constructed the charts. Major sell-offs. Okay, so let's just get an idea of how big that sell-off was. We saw 42% drop, 37% drop in 78 days. So these stocks have been killed, and now we've seen a pretty nice bounce off the bottom this week. So even before the market recovered, up 19% in 3 days. But as you could see, a big bounce, but still a lot of ways to go. And now you're going to get to an area with overhead supply and potentially resistance at the 50, which you see held here. ConocoPhillips, similar pattern, did get above the 50. Its next resistance is up here at the 200. Whiting is one that I bought, looking for a little bit of sort of a J-hook pattern, and it got up to the 17, had a PSA reversal, obviously resistance here at the 50. I saw this as a good opportunity to do a vertical spread where I bought in the money calls and sold them out above that 50 because I would think that that's going to be resistance. And here's Hess. Again, similar pattern. That 50 failed here in November. We'll see what happens here. So I think the picture is pretty obvious. These are beaten up stocks with broken patterns trying to make a recovery. I'm back in a little bit, but we'll see. Oil service are the second group down. This is Schlumberger, and Schlumberger sort of has a similar pattern. Deep sell-off. So down 34%, and it's bounced all of 11%, which looks a lot less than the 34% fall, which is sort of the, you got to make more to recover than you lost on the prior decline. But similar to some of the oil stocks, it is broken above moving averages. Next stop here is the 50. And again, I bid a vertical spread there, bought an in the money call and sold one above the blue line. Has earnings per share growth. It's the big kahuna, gets a premium in this space, pays a small dividend. But if oil goes down again, it takes these with. Here's Transocean Rig. A lot of these stocks had bounces this week. You buy at your own risk. At some point, it's going to be a good time to be buying. Maybe that point, it's Neighbors. Here's Noble NE. Maybe that time is right now. Next group down, number 3, is biotech, been my favorite index. So I'm going to give a few comments about biotech. These have been great things to own. Biotech is very seasonal driven. And if you look at, for the next month, and you look at the XBI, the XPH for pharma, the XLV for healthcare, you could see that overwhelmingly over the next month, 6 out of 8 times, 13 out of 16 times, the healthcare sectors are positive. If you looked at 1 month performance, biotech, let's go down here. Well, let's not go down there. Is up an average of 7% over the next month, 6 out of 8 weeks high. So things you need to know about biotech. You have stocks like Gilead, Biogen, Amgen, Celgene, Regeneron, Alexion, that are pretty big kahunas in biotech. And by being big kahunas, they have earnings and revenue growth. They're usually acquirers, not the acquiree. And their stocks will move based upon news, earnings, news in the space. Gilead stock, which I think Gilead's a great company, has been whipsawed because of concerns about pricing. And then you have stocks like ISIS, Puma, Intercept, Kylepharm, Chimerix, Newlink, and they're sexy stocks that get big moves, go on nice runs, but you're buying those stocks on news, and they're purely technical. Some of them are going to get bought out by the big boys. Some of them are going to have outstanding moves, and some are going to look like Arrowhead. And I pick up Arrowhead because I just saw it on the list here as being a stock that sort of met the definition of a pump and dump. Now, where did it, not pump and dump, but one that went up and came down hard. I thought I saw it here, so let me, Here it is. This is what you got to be aware of when you buy biotech, especially if you're buying one of these stocks that is a story stock that's years away from revenue or money. Arrowhead Research was a big cha-cha-cha stock in 2013, early 2014, running all the way up to 28, and then it ran all the way down to $5. Ran up on story and excitement, didn't pan out, and you see where it's at right now. Intercept was one, go look at my post on like January 5th or 6th when I said, watch out for this one. Same pattern, big run up on news, and then it's become a great stock to short, although there was some small opportunity to make money on the long side here. You see this big candle that closed halfway down for that day, but it's gone from 400 plus to about 140. Now it's had a strong week, but you've seen that pattern once, you've seen it 100 times. A couple that are doing that pattern now to be, I think, careful of. Bluebird, exciting, beautiful, love it, it's great, it's interesting, it's fantastic, but it's news driven. May turn out to be a great story. It may just be a great story that's a little bit early. Let's see if I can find the other one I was looking at. So you've got to know what you're buying here when you buy stock patterns like this. You can't be buying this because it's a technical setup. All right, these things meet the definition of high jump, except they haven't been trading long enough. You're buying these on news and in excitement. Now this one, Celgene's got a big piece of, and an option I think to buy more of. It's an IPO. It doesn't make any money. I'm very nervous about those. What I'm not nervous about are the big boys in biotech that are, as you'll see, they have great earnings momentum. They make money. And I think they have an excellent chance of being leaders going forward. Here's Gilead. Trades at a multiple of 18, and it grows at a multiple 100% per quarter. Now that can't be true, can it? So let's go look at MarketSmith real quick. And let's look up Gilead and see what MarketSmith suggests for its earnings per share growth. Now, it's not that these stocks don't have risk. They could have failure of a drug in study. It could have competition come to market. It could have a change in how they're reimbursed. Projected for 2014 was $8 earning, which was 289% growth, growing to $10 and change. The stock has a multiple of 17. It's growing much faster than that multiple. Why isn't this stock going to go to $150, $160, $170? And my bet it probably is. The issue here is they've got competition from AbbVie on a drug that recently was approved. And they have this overhang of reimbursement concerns because their drugs are expensive. As somebody who's been in the healthcare space for 30 years in this country, that's crying in spilled milk about price. Congress in 2003, on their own, eliminated their ability to negotiate price with drug companies. So they can scream, they can make a big deal. But until our Congress gets together and passes new legislation, they can't make a difference. So we can scream and complain about the high cost of drugs. They are what they are until there's a change in the law. If you look at weekly Gilead, you can see a pretty nice pattern. This is why the last 18 months, 2 years, I've been talking about Gilead, and I called it my stock of the year for 2014. And considering where it came from, I don't think it let me down. Still love Gilead, and I have a long position in Gilead. ISIS is one of the story stocks. They've got a lot of partnerships. They don't have any drugs on the market. Big gap up on Friday. You see a Bible gap up here, mobile breakout, a kahuna, on balance volume is positive. It wants to run. Technically, it looks great. It does have some periods of earnings that come in on license deals. But the thing about this is it's news driven. That's okay, just be on the right side of news. Part of being on the right side of news on these small stocks is you need to know when their PDUFA dates are. Those are the dates that we'd expect the FDA to rule on whether or not a drug is going to make it to market. When are the major meetings? Like, for example, for cancer drugs, it's the beginning of June, called ASCO. For blood drugs and breast cancer drugs, it's the beginning of December. But if you're looking at a rheumatology drug, a urology drug, you need to know when those major meetings are, when data will be presented. Biogen broke out of resistance. Going back for, let's go to weekly. I think it broke out of long-term resistance actually this week. And you could see that the last time it did. It's at all-time new highs, broke out of the early 2014 resistance. Now also pay note of the peak in February and then the sell-off. That's not unusual to see weakness in biotech after January. So Biogen IDEC breaking out to new highs. It doesn't have the earnings power of something like Gilead, but I guess you could argue that it's got a much deeper portfolio, and Biogen IDEC does a lot of work with drugs that are called orphan drugs, long patents, and good pricing power. Celgene, another one of my favorites, and one of the leaders. Well, here's Amgen first. Amgen is a stock that was dead for years. Interesting. They get a CEO for 10 years, or 8 years, nothing happens with the stock. They get rid of the CEO and the stock goes crazy. It went crazy, though, because they've come to market with a number of new cancer drugs and other drugs that seem to be growing their franchise, but they don't have the earnings per share growth of Gilead. Celgene, one that does have earnings per share, you could see 2015, 32% growth off of 486. That stock is worth, I think it's a $140 stock in 2015. Now that's only a $25 move from here, give or take, so, or 20%, but I still like Celgene, and you could see Celgene had a nice recovery here and moved up Wednesday, Thursday, and Friday, spinning top on Friday, taking out the PSAR with a pocket pivot at Kahuna on Thursday. So a lot to like in biotech. I'm a fan of the big guys. I get questions of which drugs do I think are going to be bought out next. This is one that I have a substantial position in. I don't know anything about the company. They do make a cancer drug, and they have a number of licenses in the marketplace. This company is called Merrimack, and it's had a great run. It's probably too expensive, perhaps. Again, it's a story, not about revenue or earnings. Ariad is one that used to be a darling of our board, and then it had some issues with the FDA, which the drug came back on the market. It seemed to start moving this past week, not sure why. At Kilion, they also make a Hep C drug that will probably be used in combination with the Gilead products, and this stock has been a good one. Interesting, AbbVie is one who got an approval of a cocktail for Hep C on Friday, and their stock really sold off a little bit or came back to break even. It was up earlier in the day, so not much happening with AbbVie, although they got their approval. Enough about biotech. Specialty pharma. So the first one's a story stock. Again, if you knew something, or you were a believer, or someone in your family has Huntington's chorea, so you are overly concerned about it, you might have known that this stock was developing a drug for Huntington's chorea, which is a rare genetic disorder, and it had positive news came out and it gapped from 24 to 48. Now, I look at these stocks and I go, did I miss something? Should I have found this stock here? Well, the interesting thing is the day before the news, there was no volume. So often volume was the signal. There was no volume. So God bless you if you knew something. I wish you would have told me, because what a great move this had, but it's already had its move. Receptos, don't know anything about this company. It doesn't make money, but something must be exciting because it trades at $130 a share. and it's had just a huge move, a doubling since the middle of October. You do research, you read the news, you read the 10Ks, you find out about the company, you go to the website, but most likely you know somebody with the disease that they're treating, and you got not inside information, but you were aware of something you might not otherwise been aware of. Here's one that also looks interesting. This is Mallinckrodt, MNK, and this is a company that bought Questcor. And if you remember, Questcor was a darling of this board as well, had some issues around reimbursement, but breaking out to all-time new highs with the Kahuna Pocket Pivot, everything is green, great earnings per share growth. I think that one looks interesting. Go back. Infrastructure software, Oracle, interesting to see that's at the top, way above Palo Alto. Now, if you remember, the Force ranking thing looks at change in volume and price, or not change, but amount of volume. And Oracle's got obviously huge volume on an average day of 14 million shares. But something happened with Oracle, major breakout on Thursday. Everything is green. Mobile breakout from a squeeze. Bible gap up, a Kahuna, makes money. Do your homework, read the news. Big technology stock. Red Hat also gapped up. I suspect there was some news in the group. Maybe it's related to the Sony hack. I think I saw somewhere that they were going to use Red-Eye material or Red-Eye software for protection. And you can see Red-Eye had a mobile breakout from a squeeze on Thursday. 2 Kahunas, pocket pivot, everything is green. This might be one to look at as well. Sort of my favorite in this group is Palo Alto. And if I was constructing a leaders index right now, I can assure you that this one would be there. I mean, I'll put a clean view up and you could see I like tight lower left, upper rights, and this one took off after a pullback in May, and it's just gone from 60 to 120 and just looks great. Next group down, this is what top down is. It's getting a sense of what the market is doing and then looking at the top few stocks in each industry that comes to the top. More energy, so you could tell, and I showed you some of those returns, big week for energy. So the integrateds might be better or more able to handle a slowdown in oil pricing and are less likely to have major debt problems because they can sell off assets. Here's Exxon. You can see earnings per share growth going down. It does have a dividend at 2.9%. Looks like the other ones did get above its 50-day. Here is Chevron, similar pattern, as well as BP. But you can tell these things have all been in pain for a number of months, and this recent drop in oil just was the last straw. Energy, strong, again. Now we'll see how long that lasts and whether or not the dollar goes up and kills oil. Early on, oil's up 27 cents. So internet media, can you say Facebook? What really popped Facebook was when somebody came out and put a valuation of $35 million on Instagram, or $35 billion, which is a lot more than they paid for it. Now, it's been going sideways and basing really since September. And we had a mobile breakout from a squeeze on Thursday, another move up on Friday. Pocket pivots, Kahunas, on balance volume heading up. Got to get above resistance here. And I think that's what I'm waiting to see before I get too excited about adding to my position. But Facebook looks pretty strong. Google, it looks like an oil stock, doesn't it? It's got earnings rates that are going down now as it's getting a little bit more mature. Maybe it's got a lot of competition for what it does. I think you can make the bull case as well. But looking at the stock, it needs to show me something. And like the oils, it's got to get above some of those moving averages. LinkedIn, LinkedIn, I had putting on some targets and some trend lines from up here. And LinkedIn is sort of where I thought there'd be resistance. Right now, LinkedIn is, perhaps you could say it's even in a trading range here. And I'm not going to touch it until it breaks above or below these lines. But it did have a Kahuna pocket pivot. This is a weekly. Let's get out of that. So it failed here with a sort of a shooting star. Everything's green. Did have a mobile breakout, kahunas and pocket pivots this week. So that might be one to watch as well. Diversified banks. We've talked about banks, I think, for a couple of weeks. Here's JP Morgan. The one I went into Morgan Stanley, which is more asset management, and Bank of America. Bank of America, now this looks to me like it's in sideways chop. Well, when I look at Bank of America, I see a stock that's at least in an uptrend, although of late it's been in chop as well. But everything's green, mobile breakout from a squeeze, pocket pivot. The volume's not been real helpful. Earnings are coming in a couple of weeks. What I like about Bank of America, frankly, and those who've been watching me for a while know I'm a sucker for earnings, is they've got some earnings coming in. And perhaps with this earnings power and momentum, not only will they increase dividend, they might be better off on the issue of reserves, and we might see the stock go up. I don't think we're going to look at asset managers. I don't want to do that. Don't do that. Go back. I'm not going to go into any more of these groups, so just see what else is up here. REITs looked good this week. Steel, airlines. I want to look at airlines for a second. Have airlines already had their run, or is there still an opportunity in the airline business? So I'm long Delta, and I'm long Hawaiian, and I'm thinking about moving into American. Let me show you why. The issue is whether I add it or I replace one of my others. It trades at a multiple of 9. It's showing earnings growth in Marcus Smith in next year 47% and 8.42. Even if it just goes up to 10, that's an $80 stock, and that's a 60% move from here. I look at this pattern. Is this an ascending triangle? I'm not good at drawing things, but it's clearly got a channel here and you got something here. There you go. So I think that this is poised for a breakout and a big move higher. Delta still looks good, had a couple of weak days. If I go into Market Smith, because I think the important thing is to look at the earnings on these guys, because the charts all look the same. Here's Delta, 35% growth on $4. Here's here's American Airlines, which is 47% on $8.42. Here is Hawaii Airlines, 47 on $2.35. This is a stock that trades at a multiple of 20, but that was based on much lower earnings. If it keeps the $2.35 and gets that 20, that's a $47 stock. There's a lot of earnings power, I believe, in the airlines, and I think the airlines may be going on a run. Anything else to point out here? Nope. Let's look to the dark side. Specialty apparel had a tough week. I think a lot of concern about Christmas. Nike had some bad numbers. They brought down footwear. You could see retail and restaurants and consumer electronics led the negative movement. What else do? I did want to show you Morgan Stanley because I do think Morgan Stanley looks interesting. Now you may ask, well, Jeff, why do you need HGSI if you have Market Smith? Question is, why do I need Market Smith if I have HGSI? And as soon as George builds out this part of my picture with annual earnings and revenue, I'll probably get rid of Market Smith. He added this for me, and thank you, George, which includes the earnings per share date and the multiple. Here's Morgan Stanley, and it looks to me like it's breaking out to new highs, or at least new, probably post-crisis highs. This is weekly. Yep. It's breaking out to new post-crisis highs, and that's a monthly chart. And what I like about it is it's firing on all cylinders. It's got, let's take a look at its earnings in MarketSmith because they go out further. Plus, it's got MS as MS, so I got to put MS in MS. Look at this, $3 essentially, multiple is 16. If I don't get a rise in multiple with this rise here, it's at a $45 stock, $8 from here, 20%. I'll take it in this market. Other things that I've done as part of my analysis, I'll go into all groups, all securities, and I'll look at stocks that had unusual volume on Friday. So these are the stocks that had 5 times volume, and let's just see if anything looks interesting. This is how sometimes you find something that's below the radar screen. First thing is there's a lot of precious metals there, which is interesting. So I will just quickly go through. Not interested, too cheap. No. If I'm looking to buy a gold stock, it's cheap stock, but okay. So we looked at a number of biotech stocks that had huge moves. I don't know anything about Aratana. All I know about Aratana is on Friday, on 12/10, I don't want 12/10, that's not Friday. On Friday, its volume was 2.9 million, and its average volume, or where it was the day before, was 228,000, 194,000, 227,000. Something happened in this stock, so I might want to go figure out more and see if there's a story coming in here, and I want to get in because before it goes to 40. And I think this is what I like to do to find leaders before they break out. Foundation Medicine, First Majestic Silver. Is there a bunch of inexpensive? PHH. All right, I'll look at volume breakouts. Other things that I do is I have a filter that is in the downloads, which looks for stocks in an uptrend that have forced kahunas and are near the 50-day moving average. So let's just look at these. So $2 and 150. They're in an uptrend as they're above their 200-day moving average, and they're within 1% of their 50. So I'm looking for stocks in an uptrend that have pulled back to their 50 and are firing with momentum. Here's Dresser Rand that looks like a takeover, so who cares? Silver Bay Realty Trust, sideways, not much. It did pull back, and I'll get through the 50. Doesn't do anything for me. Infuse Systems, too cheap. New York Mortgage Trust, sideways. Whoopsie, sideways. Well, didn't work today, but what I'm looking for are stocks like this one. Here's a stock that likes to do this over and over again. I'm not advocating Lanet today, all right? But what I'm looking for are stocks that like to pull back to their 50 and then take off on volume, or on rather kahunas here. So this was one of my favorite buys earlier in the year. You had a mobile breakout and a Bible gap up from a squeeze. You had a pocket pivot and a kahuna, and I found it because of my screen of coming back to the 50. I wouldn't touch JNUG right now because, well, unless I saw a signal tomorrow morning. Similar pattern, I was doing a presentation at a meeting and local user group meeting, and I saw the pattern of, when I ran this scan, where did that go? Yeah, it's right over here. Of a stock that had been an uptrend, pulled back, now broke above the 50, on a kahuna, had a mobile breakout and a squeeze, and that was a nice run there. So nothing looks like it's popping in that scan. I also look at my PSA reversals close at a squeeze. So these are stocks that are squeezing, and they are right underneath a PSAR stop sign. And if they trade up tomorrow, then they potentially are triggering a buy on that basis. So here's BioMarin, one of those small biotechs, nice uptrend, pulled back, had a kahuna on Thursday. And as I look at this, if it can break above this dot, that gives me a buy signal coming out of a mobile breakout squeeze and a kahuna. So that might be on my watch list. It's got some recent highs over here to the left. I don't like this stock as much. Weyerhaeuser, this is nice. Lower left, upper right, pulled back. It's right underneath the PSAR dot, mobile breakout from the squeeze, pocket pivots and kahunas. Everything is green. It makes money. So here's a stock. If it breaks out or takes out that dot and trading early in the morning tomorrow, that might be one that I'm looking at. So I'm looking for stocks that are hopefully in an uptrend, that are right below the PSAR dot and are squeezing, which means they've given me a little bit of a breather, and I'm looking for a move that triggers a buy signal. In this case, if it trades above that dot will switch to the bottom and turn green. That's a buy signal. Pocket pivots, kahunas, everything is green from above. And for example, Bank of America, which we looked at earlier, although it's kind of a sloppy pattern, is sitting right there underneath the PSAR dot. Why do I like that? It's very simple. Let's say I have a $100,000 account. I have a 4% risk tolerance, so I'm willing to lose 4% of that, which means on any trade I take, I don't want to lose more than 4% on that trade. So if I'm going to have 10 positions on a $100,000 account, then each position is $10,000, and I'm willing to lose $400 on a position. Okay, simple stuff. So I open this up here, and I bring it over. So if I was to buy Bank of America Monday, where would I want to buy it at? I want to buy it when it takes out that red dot. So that red dot is at 1770. So let's say I buy it at 1720. I'm going to probably want to put my stop down below this line here, this trend line. So my stop is, say it's at 1660. 1660, stop, 1720, buy. How many shares can I buy? Well, if I'm putting at risk 60 cents on every trade, then I could only lose $400. So 60 times 700, 650 shares of Bank of America. So let's do the math. Oops, I hate when that happens. I don't want to do that either. Let me see if I can find my calculator here. I'm on a different computer, and if I can get it over here, I will. And if not, we're going to just call it a night. So the way I do simple position sizing, I don't see it. If I'm willing to lose 60 cents a share, the most I can lose on this position is $400 and be comfortable. Then I can buy up between 600 and 700 shares and meet my need. The beauty of this is I could set a buy signal when I go to sleep tonight. If the stock trades above that red dot, I want to put a buy in at 1820. No, where was that dot? I'm sorry. At 1770. Actually, it's $1.10, so I can only buy 350 shares. I did my math wrong. I'm going to put my initial stop either at the 50 or, if I want to be more conservative, at the rising trend line. I'm going to take what my risk is in cents. So I was wrong on my number. So let's just say it's 1780, and I put my stop in at 1680. So I'm risking $1, which is 6%. I can lose $400 on the trade and not break my rules, so I can buy 400 shares. I can go to work, I can get on a plane with the knowledge that unless I took out the red dot, I didn't make the trade, and immediately I set a stop order which limits my downside risk, and then I can raise that stop as the stock moves. On that note, I'm going to say good night. take a quick look again at the futures. See if they're nice to us. 22.5, so they're holding their own, not much of a change. And I'm just going to stick up here before we say goodbye the invite to my upcoming meeting. We have about 17 or 18 committed. I needed 12 to not have to worry about having to cancel a meeting because of my cost. So I've already told people there's absolutely no way that meeting is going to be canceled. So I have discount rates on hotels at the Best Western. It's actually passable and acceptable. Actually fairly nice. HGSI Doc is the coupon code. My email is hgsidoc@gmail.com. Please email me with interest. I'm not sure how many people I want to bring. Probably no more than 25 because then it gets too many people for George and I to teach. See you all soon. Thanks. And this is it. Good night, everybody. Good week. Happy holidays. Merry Christmas. Happy New Year. You probably won't hear from me until I do an end of year review. Goodbye, everybody.